welcome back to another lesson. So today's lesson is going to be the first of a new batch of lessons based on theory in a way, right? The theory side of stuff that we've been studying. The way I planned all the lessons when, I was writing everything up and whatnot, I wanted to kind of teach you guys in a specific way. I want it to be like, first of all, here's the charts, here's the basics. This is what we do. Do this, do that. But now I want to start breaking it down into why we're doing that, to develop that understanding, right? Because that understanding is going to help you guys, build better biases, pick better trades. Once you have a true understanding of what price does in a general sense, and of course, just generally make you better traders. The reason I left it until now, I just wanted to teach it this specific way. I'd rather show you guys, this, that, this is why we do that. And now when we break it down, hopefully you have those, that makes a lot of sense moments sort of thing, right? So let's get into it. I'm going to try and keep these lessons relatively shorter in a way because, I'm not going to be on the charts or, I can't really think of a topic where I'll have to jump on charts, maybe a couple, but it's going to be purely me talking. But make sure you guys make notes on this. This is, important stuff and it can be a little bit confusing. So if stuff is confusing, please come to me and ask questions. I know that especially this side of stuff may not be as easy to grasp. So let's get into it. The IPDA, right? Some of you may know what this is, right? I'm assuming, especially the beginners, you guys want the Interbank price delivery algorithm. That's what we're going to be talking about today, yeah? So, what is this, right? The price on our charts, right? It's not from people. It's not, normal people buying and selling Euro USD and that's why the chart's moving. It's not, a lot of people just, bought in and now the chart's pumping. I just placed like a 50 lot trade. Now I just moved the charts. It's not how price works. Price is delivered by an algorithm, right? What does this mean? In simple terms, the delivery of price that we're seeing, right? Literally, the way we're seeing price move and go to certain places is done by an algorithm. Down here, I've got the definition for an algorithm, right? It's a finite sequence of instructions, performing a computation in this context. The way you guys should see it, right? If price is algorithmic, think of it as robotic, right? Think of it as repeating. If it's a sequence, what do sequences do? They repeat. It's like a pattern, right? And if it's a computation, it's in a way, we can say artificial, right? Everything is manipulated, is created. What the algorithm is working off of is time and price, right? When we think of time and price, I've mentioned this to you guys before, and now we can get into why we mentioned time and price. Why is time and price important? When we have an algorithm, any algorithm, right? I'm not too familiar with computer science and all of these things, but after doing my own research, after learning about this from other people, algorithms need some sort of time reference, right? There just has to be one of, how long it takes the algorithm to repeat, for example, right? We said it's a sequence and it's computation. And if it's a sequence, at one point it will repeat. So therefore, the algorithm requires, a sense of time. And of course, we have our price. We have actual price levels, our references to price. We can consider our arrays, your order blocks, your fair value gaps, everything. They're references for the algorithm to price, but we also have references to time that we'll get deeper into. Let's think about time and price in a practical way that I have taught you guys, right? Let's think about the weekly candle. You know how we said Tuesday has a 70% chance of making the high or the low of the week, depending on your bias. And then we had assigned roles for like other days as well, yeah? That comes down to the third point, behaviors and data. I wouldn't really say the algorithm has behavior, right? Because it's coded. It's not, like habits or something like that. It's not a person. But these behaviors, these things it does repeatedly, you can track with data. In that lesson, I told you guys, go back and test several weeks. Test a year, 2 years. See which day makes the high or the low of the week in bullish and bearish weeks. Collect the data. That's the important part, right? Collecting the data to prove that this is what the algorithm does. If it's being repeated every so often, right? 70% is quite high. If it's being repeated that often, then clearly, there's something behind it. It's not, every Tuesday everyone said, this is the day we're gonna, put the most money in the market and push it down or up. Like, just think about it logically for a second, right? There's a reason behind it. There's a reason it's that Tuesday. Makes sense for it to be an algorithm, right? Repeating behaviors, repeating sequences. Yeah. The next thing I want to touch on is New York Midnight Price. That's another reference to time and price. We'll get deeper into this. And again, like I said, this is just the first of many lessons. So this is more of like an overview. I just want you guys to, kind of digest all the information slowly and really understand what we're talking about. New York Midnight Price, right, is the time where the high and low of each day is decided. It's pre-programmed in the algorithm. It's not, it just randomly changed midday. It's already pre-programmed. At New York Midnight Price, the algorithm already knows where the high and the low is going to be put in. And that's just where it's going to get put in, right? And we have ways to measure that. It doesn't mean they're always accurate, but, including things like actual New York Midnight Price itself, contraction, expansion, CBDR, whatnot, right? They're references for the algorithm. So let's talk about liquidity. So I've been saying for a while, right? I'll make a zoom on this. So my bad for not doing this a bit earlier. We already spoke about price delivery and how price is delivered by the algorithm. Of course, now you guys understand, or at least I'm assuming you understand, it's not people, it's not buying and selling pressure, it's not volume. The algorithm is delivering price, right? That's the first point. Stop orders versus stop loss. Now this, right, is a big misconception. A lot of people think when we say, we're like seeking liquidity or hunting stops, we're not talking about stop losses, right? That's not what we're talking about. Of course, the algorithm may simultaneously trigger stop losses, but we're talking about triggering stop orders, right? A lot of people actually aren't familiar with these, I just realized. But this is something old. The original's over on my Instagram if you want to see it with all the other types of orders. For what a stop order is, right? This is a retail example of stop orders. You have your support and resistance, and essentially they're trading the breakout. When this resistance breaks here, they have a buy stop. So what happens? Once the resistance breaks, you get put in a buy position. And same here for sell stops. Once your support breaks, so like retail support this is, you get into the sell position. Now, let's just talk about these for a second, right? I don't know any person that uses stop orders, right? But big institutions do, big, let's say companies, banks, and whatever with lots of money. The markets, right? Let's take a step back first. What is this algorithm doing, right? I'm talking about all this price delivery, blah blah blah. Like, yeah. Let's ignore all of that. Scrap all of that for a second. At its very basic, what is the algorithm doing? Facilitating trade, right? But that's what the forex market is for. It's permitting trade between currencies and, in a way, countries, right? Central banks. The market moves $6.6 trillion a day. The forex market, this is. So do you think in that 6.6 trillion, right, us lot with, let's say everyone in this group chat with, let's say we have a combined net worth of 20 million, like this is, of course, I don't think we do, but, if we have a combined net worth of that, and even if we placed all of that into trades, do you think we even move in the market? No. There's people, or rather institutions in the market with billions, right? They're the ones placing these stop orders. They like to be in and out of the market quick. So, what is, right, smart money now? Let's think about it for a second. Smart money are people who we can say, in a way, are the winners of the market. Most people don't win in this market. You know what's a very big misconception? That banks win in this market. Like, banks just make money. They don't. Like, normal banks, they don't just hop into this market and necessarily make money. You can go search, their stats and stuff, and you can see that they don't. We trade with smart money. Smart money, we can say, are bigger than banks in a way. Big institutions, and they know what they're doing. So when we trade these smart money concepts, we're trying to get in line with what they're doing. A prime example of this is IOFED, right? Their understanding of the fact that the algorithm, will come back to this imbalance in line with bias. It will sweep liquidity. Remember, that's the two main jobs for the algorithm: seeking liquidity and rebalancing the market. IOFED is a perfect example of doing both. With your sweeping liquidity into an imbalance, so you're rebalancing some of that area, then you're trading away in line with your bias. So cool. So in reality, all these things we learned, we're not really, like, in a way, I guess, trading our own things. We're just getting in line with what smart money are doing. We're following where the money is going. So, right, back to this stop orders and stop losses now. When we have these stop orders, right, what's this? 1 and 2. They're old highs, right? If I showed you guys these on a chart now, you guys will mark this as BSL, buy side liquidity, which is good. When we sweep liquidity, especially external liquidity, what happens? We take it, then we trade back lower. But why? What happens when we take it? When we break this level, when we break above or below old highs and lows, right, we trigger stop orders, right? This is when smart money enter the market. They wait for these sweeps, right? Why? Look at the third point, pairing orders. What is pairing orders? Can you buy something if someone isn't selling it? And can you sell something if someone isn't buying it? Just think about that for a second. So when they buy here, what can smart money do? When these buy stops are triggered, what can smart money do? Match all of them, pair their sells, and let price come lower. Right? Does that make sense? We break above old highs and lows. We trigger stop orders, and that is when we look for sales. Now let's think about it practically. Market structure shift. What does the MSS do? We sweep liquidity, right? We have that shape. Go down, we go up. When we go up, what do we sweep? We sweep that previous high. And then we trade lower. We also take out this low. Sweeping this high, that's giving us that, and then sweeping this low, is the algorithm telling us, we're ready to trade lower. But what's important is we swept that high. We triggered some sort of buy stops. We started to trade lower, right? That's your confirmation to get in now. Of course, every market structure shift, every valid one, right, will have that sweep. That's very key. Even every SMR has sweep of, liquidity. That's why it's called a smart money reversal. Think about it now, right? That should add up. Smart money reversal. What did I just tell you guys 2 minutes ago? When do smart money get into the market? After the sweep of old high or low, right? Sweep of liquidity in simple terms. And what is an SMR? Essentially, just a market structure shift after we've swept liquidity. Swept old highs and lows. What does SMR stand for? Smart money reversal. That should make sense, right? Now, this one, I'm going to get deeper into, and we can use this every day in our trading. But in very simple terms, right? Offset accumulation and offset distribution. Offset accumulation, please make notes on this, it's important. Offset accumulation is when we sweep a low and then, of course, have a move higher. Usually, you'll have displacement. Not always, but, usually. Offset distribution is the opposite. We sweep a high and then we trade lower. You can find examples of both of these in the kill zones. I'm going to go deeper into this. It's going to have its own lesson. But for now, just you guys understanding what I'm saying is enough. There's a bit of a shorter lesson, but I feel like there's a lot to digest in here. I've kind of thrown a lot at you guys, right? So make notes on this and try and understand everything. If there's gaps in your knowledge, please come to me. It's necessary that you're taking in everything, because in a way, this is like a chain of events. And it's important that you can take in everything that's happening and truly understand it before, we start moving on to deeper things. Because as we move on to deeper things, you need to have your basics solid to understand everything, right? That's about it for today's lesson. I hope there's a lot to take away. I hope some of you kind of did have that, that click moment where certain things make sense. If you're up to date with all the lessons and you're watching this, which you should be, then, I hope some piece of the puzzle click in place. But I'll be back soon. The next lesson will probably actually be on offset accumulation and offset distribution and understanding how the market uses liquidity to move, how we deliver from, buyers to sellers and sellers to buyers. So that'll be interesting lesson as well. But that's it from me today. Here's all my socials. I also got TikTok if you guys want to follow me. It's dots10p as well. And if there's any questions at all, please message me.